famous quote of Charlie Munger was, when somebody comes at you in a presentation with EBITDA, run.
That's great.
Holy fucking shit, it's a dinosaur! Jesus Christ, what the fuck?
Welcome to yet another edition of the Grey Market Talk on the Tactical Brief between Thorsten Wegener, a former market maker for options, so I'm an equity boy, and my bond master, former portfolio manager, chief investment officer, bond trader, golf player, and the person now I'm shooting the breeze for how many weeks, Nick? 32 weeks in a row?
No, this is, I think, 31.
I have to count it. I think we're on 32 now.
See? So
Yeah.
This is going to be something we'll have to fix.
Which also gives me the possibility to have an announcement. Next week will be our last show for the year because we have to do things. It's Christmas time. So we will have a look at what we told you, what markets could do and what they can't do. Obviously, we'll only show you the good stuff, Nic and I talk, and completely ignore my NVIDIA short trade I had in there. I'm not going to mention that at all. And first of all, Nick, hello. Thank you very much for spending the time with me on a Sunday morning.
Happy first Advent.
Oh, yes, of course.
See?
It is. I got my Christmas tree this week. It's already downstairs. Not very German. And usually when I grew up, it was hidden before the 24th. My mother's set it up in the night, on the night before Heiligabend, Holy Evening. And that's when we saw it. And it went out of the window by the 6th of December.
Yeah. No, 6th of January, you mean?
6th of January. Yes, of course. So, no, I have mine already in the hall. It's nice. It's looking good. Just have to decorate it. And then we can dive right into the show for the week. Let me try to share my screen. Our Grey Market Talk on the 1st of Advent, 2023. Unbelievable how fast time flies. And I'll start briefly with my thoughts from abroad. You've heard this on this show before, Volkswagen. Yeah, we had this topic, and I'm still perma-bear on the German economy and also, well, the development of the German markets. Stuff Christmas rally or not, it's not a good predictor if the industry falls apart. And Volkswagen, their brand chief, came out last week and actually said, we can't compete anymore. We really have serious troubles. And we raised that on this channel before when they said, okay, we might cut down or cut back a little bit on our contractors. And now the conversation at Volkswagen actually started, how can we reduce staff? We have to, we've made mistakes, and it's clearly coming from the electric vehicles. People are not buying them, and we've re-equipped factories which are now not working at utilization. Great, yeah. People are not buying that. On a different note, I ordered, and I only remember that exactly when, on the 6th of December, 2019, my Cybertruck, when they told me it would have 500 miles reach and you could buy it for $55,000 US. Elon apparently is delivering the first Cybertrucks personally, and now we're down to 300 miles, and they've jacked up the price by 20 to 30,000.
Wow.
So Client Thorsten went on the website and said, okay, I'm canceling the option I bought for $100 in 2019, when I thought, yeah, well, they might deliver it within 6 to 9 months. I wonder how many people are doing that. Not that Elon might be worried about the $100, but I don't know the booking or the accounting shenanigans they did for this huge log of back orders for this car. I think a lot of people will think like I do, especially with what's going on at the moment, electricity price going through the roof. We now have a new law in Germany on the books that the Netzagentur, the guys who are controlling the grid, can switch you off, Nick. Did you know that?
No, I didn't know that. And it's, you know, that's the advantage of command and control. You can do what you want.
If you have one of these Wärmepumpen, yeah, of these, well, how do you call it? Air conditioning for warm and cold, which they made a law that we all have to have that in the future in Germany, which are run on electricity. So if the grid is in trouble, they're going to switch this off first or reducing it, and at the same time are reducing, you couldn't make that up, the loading points for electric vehicles.
They will reduce them as well. Yeah, is that what you're saying?
Yep.
And the electricity goes to industry, which won't be here anyway, because it's all sort of going to other countries.
See, you always see the upside in these things, Nick.
But just saying, I mean, you know, you've got this Volkswagen thing, and of course we're in Germany, and Germany is the place around the world that has its name for quality vehicles. I was walking in Frankfurt yesterday, and I passed 3 shops, all in a row. First shop was NIO, you know, their electric cars. The second shop was Polestar, showing their electric cars, and the next shop was Genesis, showing their electric cars. Fascinating that you just don't see the German brands anymore. And I know that down the road Tesla has a little showroom as well. You know, it's missing. So even in the electric vehicle space, where all of these guys have now run into, they're running into competition because it's really easy to set up these Porter's 5 rules, where you say, is it difficult for competition to enter your space? The moment you go into electric vehicles, anyone can do it.
It's the little things, I think, that count. Here down the road where I live, there's a guy who has an electric, I don't know what it is, but he doesn't have a charging point in front of his house. And you couldn't make that up. He has an extension lead from his bedroom from the first floor hanging out of the window to reach his car parked in front of his house. And I don't see any building or construction activity to supply actually everybody here with a charging point, high power charging point to run those cars. Never mind that we don't have the energy in the grid anymore, that we are a net electricity importer. And well, it doesn't really come as a surprise for everybody who's able to think what's happening here. And Volkswagen, obviously they were politically driven, to support this and promote this electric vehicle, and everybody's going to drive electric in the future, which is nice. I was a big fan of electric before all these shenanigans happened, that they forced it on me. I like the idea it was cheaper to fill your car up with electricity. I like the torque these things have. And you have less maintenance with it, because what do you have? You actually have an electric pencil sharpener with a bit of luxury in it. So, but no, if they take that away, and if I can't drive to Berlin in my Cybertruck on one charge, I'm not going to buy one.
The good thing is it's bulletproof.
Yes. Yeah, do you think we might need that with our here on the net? I don't know. Anyway, but there is hope. There is hope. German exports are doing fantastically well, which also is our absurdity of the week. In Kyrgyzstan, former Soviet Republic. I had to look it up in Wikipedia on the map where it actually is. And what you can see here, when Russia invaded the Ukraine and all the sanctions came in, obviously German products like machinery, others, motor vehicles and parts were not sold to Russia anymore. But finally, we could pick up a new trading partner for the future, for the next 20, 30 years, hopefully, which will make us all rich. And that is Kyrgyzstan, with 7 million people living there. So they're as big as Ireland, right? Fantastic. I'm just mesmerized which genius discovered in our German automotive industry. You know what? We never focused on Kyrgyzstan. There is huge turnover and huge profits to make. Let's plow in there. And hey, what we're doing. So it's fantastic. I'm looking forward to doing business in Kyrgyzstan myself. Nick, have you already planned to set up a dependence in there? I don't know what the capital city is. I should have read it further.
Well, I know exactly what you mean, but obviously it's, as you say, the absurdity of the week, but it effectively shows that these sanctions are, they just don't work.
One big sham, isn't it? It's just you can't wrap your mind around. Anyway, let's come to the positive side, what people want to listen to. Markets, and the question is, are we there yet? So I borrowed a line from Samuel Beckett. You see various pictures of me waiting for Godot. He'll never arrive. When do we see the pullback? When do we see the recession here? Obviously, I was planning to use that in our show, and Murat beat me to it last week when we had the sector rotation conversation, and he put this fantastic picture on the screen as well. And that's how I feel at the moment. Not that I've built up huge short positions, but it would be nice to see actually things which are undermined by the data to finally rope in. And I haven't seen that yet. So I thought, let's do some ocular regression analysis. Simply we're looking at charts and talking about it, Nick. That's always big fun, especially when you're a bit lazy in preparation, as I was this week. We start with the S&P. We are at a crucial level at the moment, and we will come back to that later. Nick, what's your general take on the equity markets at the S&P at 4,600 at this crucial point we've seen in July, August last year? Yeah, didn't make it, had a nice correction underneath the 200-day moving average. Now right at this point again.
Yeah, I mean, you know, we've spoken about this over the weeks, and for anyone who's been following us should know that, I mean, here we have a low somewhere around March, yeah, where we started our talks. So we've been talking a bull case. I've been talking a bull case, of course, we've been slightly disagreeing. And then we talked about a correction down to the 4.243. We went through that, but we said we're not allowed to break this 4,100, which was the very first peak you see around December of 2022. And we just held, I must say, by 3 points. So 4,103 was the low. And the market's taken off. And we, you know, when we did an Elliott wave analysis on this thing, we said it's more likely that we're going to be in wave 5 after it's rallied from that low of 4,100. So the question is this the first wave of 5 waves up, or is this going to be all of wave 5? My own view is that the equity markets still have another year or so left to run, which means, you know, my initial target was 4,900, and it looks as though if this is a wave 1 of wave 5, then, you know, you're talking about sort of mid 5,000 level, so 5,500. So it looks like it will be, you know, much larger than I thought.
So in your wave count, obviously I don't have a clue about Elliott wave. If this is wave 1, but we would
of wave 5, yeah, of the last wave. So
we would be set actually now at these levels for at least a correction.
Absolutely, it would be. It's very difficult though, and I must say, even for an Elliott wave guy, you know, when you've got a chart which is effectively a straight line, you can't really put a wave into that, but you can see this gap in the middle, this sort of you know, this point in the middle, where you know, you'd say, okay, that might be the center of this whole last move from 4,100. If that's the center, then you're going to peak somewhere around 4,700, let's just say, 4,650, 4,700, before you see the correction. It is very difficult to put real waves on this thing because it is just a straight line. Yeah, it is a bit tough, even for somebody who's been doing it for a while. But on that basis, you know, correct at 4,700, come back down to 4,500, 4,400 perhaps. And then next year, first week of next year, take off again, because as I say, I think the cyclical pattern on equities is still bullish. The near-term pattern has got, you know, some tendency, as you say, to correct. Don't know where it corrects from, but it should, by the beginning of next year, start to pick up steam again, in my view. And I think we're going to see sort of good equity markets for a year, at least.
Well, we're on an extremely interesting point anyway. There's a call wall at 4,600. Yeah, people are gamma short there.
Okay.
And the interesting thing, it's a little bit out of the advanced playbook, and I know that so good because I once lost 5 million Deutschmarks by not knowing this. When you have extremely low volatility and you're gamma short, you're really FUCKED. And a lot of the guys out there at the moment are short the 4/6. And if volatility is not high, what does that mean? The closer you approach expiration cycles, suddenly you're gamma short, you're the whole lot. Yeah, suddenly you're not a fraction of your portfolio short, but it flicks in like a 0 and a 1. And then you have to start hedging that. And if you're clever, you take the first beating immediately, and that could actually pull the market right up into the region you just defined, 4.7, if that doesn't hold. So, and an inflection point where I would be willing to place a bet that we will not, I said that last week already, we will not trade around 4,600 now for a longer time. Yeah? Question for exposure, and that with volatility will dip into that later a little bit. Again, I said it last week already, at historic low levels. That's the time when you start spending money on what you usually don't do if you want to make money, where you buy options and say, fine, I sleep well at night. And if I lose money, I lose a little bit. But if the market moves in whatever direction, I'm in for a good coin, especially if volatility normalizes again to levels of, let's say, 15, 16, or even to the long-term average of a 20. So there's an interesting trade setup built in there. Anyway, the interesting point now is, we've already spoken about the S&P. I found an article in Breitbart, and it was about a speech Powell gave on Friday at a university in Atlanta. And he did his usual, yes, we are data dependent and people should not rely on the rate hiking cycle is already over and we are cautious and our mandate is still in place. And on Friday, the bond market actually decided to show him the big fat middle finger and say, yeah, whatever you say, we don't trust you. And Breitbart said he lost control of the market, where rate easing was priced in March to May next year with 0% probability. It's now at, I don't know, 17, 18% already. So how does that go together? You have the Fed chairman telling everybody, no, guys, it's not going to happen. We are cautious. And the market in complete oblivion tells you, yeah, well, whatever you tell us.
I mean, you've quoted me a few times of, the Fed doesn't really matter. I mean, it does matter. Okay, so a little bit unfair on the Fed. But one of the first things I said in the first or second videos that we did was that, inflation will fall without the Fed raising interest rates. So the money supply is the key for inflation. Money supply has been falling like a stone. It's stabilized, but it is on an annualized basis, negative. Still very high in quantity of money that's in the street, but it's certainly not growing. And because it's not growing, I can't see any sort of reason for inflation to run away, which means that you're on a downward path for inflation. And all the Fed are doing right now is effectively adjusting. They will have to adjust their interest rates for the fact that inflation is falling. Nothing to do with, is the economy in trouble or is it not in trouble? Is there growth? Is there not growth? If at the end of the day, these guys have turned the dial on inflation so high, and then in Q3 of this year, you've got almost 5% or more than 5% GDP growth. I mean, it just goes to show you that what they're doing, the dial that they're using, this interest rate tool that they've got, is kind of irrelevant. The most important thing that's relevant in for people like me anyway is the money supply. And so now, having turned the dial full up, and you've got sort of all of this growth, and there's suddenly inflation is falling, and they don't know why there's growth and there's no inflation. So they're sitting there scratching their heads. The rest of the market have kind of figured it out, that inflation will fall, and therefore the Fed interest rates will have to fall as well. They will announce that. In my view, they'll figure it out and probably make a formal announcement sometime next year, early next year. And then the markets are off to the races. It's almost like a repeat, and I think I said it last week, of the December 2018 show, except that at that stage the market was falling on the way down. But they made their last rate hike in December last year, in 2018. And then in January, they announced, oh, by the way, that was the last one. We're a bit worried. The economy is not as strong as we thought. They'll come up with a reason. And then everything was rallying. Bonds rallied, equities rallied. And I think that's the phase that we're in now, is where people have realized interest rates have peaked. And on top of that, the Treasury have helped the yield curve along by just issuing in the short end of the market and not the long end of the market. So that's helped yields even more to, help the bond market even more to rally. And that's helping stocks. And, as I say, all I've seen from YouTube pundits is we're in a bear market. You showed that picture of all the bears. And in fact, their tendency is always to say to people, oh, this is a great point to sell, this is a great point to sell. And they've been saying that for the last, I don't know, since a long time. And very few people have actually figured it out that That the market's still on the way up. We are still in a bull market. That was nothing more than a correction. The Fed played their game with interest rates a little bit, confused a lot of people, I must say. But, markets are still positive.
Yeah, well, the thing that always puzzles me is if inflation comes down, what is it? Or is it a mix out? The Fed's done a good job, yeah, by being extremely brutal, checking up the interest rates. Or is the market already seeing that we are in for a major recession or depression? Or is it a mixture out of both of it? The Fed's done a good job, yeah, but they're always getting beaten up. But one could assume, say, yeah, fine, they were extremely aggressive. They checked up rates by an unbelievable pace, yeah, and degree in there. And at the same time, the first indicators are coming in. Yeah, leading indicators are horrible anyway for a long time, that the market expects a recession. So a mix out of both of that gives us just a good scenario for long duration assets as we've ever seen it.
I think the environment is quite good. The question mark is that it's more to do with forecasts of growth in earnings. And at the moment, the analysts are really aggressive with their expectations of earnings growth. And if you assume that they've overcooked that estimation, well, we'll find out over the next year. And maybe that's when, people start to soften up their expectations. Maybe we don't get to such aggressive levels, but by that stage we'll be in the 5,000s in the stock market, and if you're short waiting for that, then you're toast.
Yeah, I totally agree with you. You mentioned
and the Fed have not done a good job, and money supply has come down. So I have to do this. Money supply has come down just purely because money gets used up. It gets used up in growth, it gets used up in inflation, and time is the cure for when you've overcooked it with your money supply. And that's what they did in 2020 and 2021. They get 0 out of 10. They missed it on the way up. They missed it on the way down. I've got no time for them, frankly. So if it's a politician, I'd be saying, what the hell have these guys been doing?
So the guys might as well be like the proverbial ape throwing darts at the wall and would have been just as successful.
Yeah, I mean, it's not really my style to criticize people, but these people have a huge job to do, and I don't think they've done it at all well. And that goes for the Europeans, that goes for the Brits. It's not just the Americans. I think the three have totally misunderstood how markets work. Go back to school, learn this stuff, and put somebody else in charge, in my view. In all places.
We had this before, right? The biggest employer of PhDs in the United States.
But I don't think it's the PhDs that are the problem. I think it's this groupthink thing that I think there are a lot of smart people there saying, excuse me, but they're not allowed to say anything because there is this way of thinking at the top of the tree, as it were, and perhaps some clever people are not allowed to express their ideas.
Well, I think the problem is the PhD in economics, not our own PhD, Tim, who has it in chemistry and builds how do you call that? Transform stuff, but analyzing the market from a scientific viewpoint. Anyway, you mentioned it already when we were talking about the yield curve, and that's a sincere question now, because you're a bit older than I am, you're a bond guy. I know the playbook, yeah? And we have an inverted yield curve, which we see right here in front of us, and then we see a steepening again. It was a bear steepener, and now over the last 4 weeks, we suddenly see the steepening re-inverting again. Nick, what does that mean?
So, I mean, we have to understand why we were inverted in the first place. We were inverted because we just described the Fed.
Yeah,
didn't really understand what they were doing with the money supply. They raised interest rates. They created an inversion. The long end was not convinced about the long-term inflation rates in the US. But nevertheless, the long-term yield is influenced by the one-year rate. So if you were to sort of create a model of where 10-year yield should be, you'd probably have part of your estimation of where the 10-year is by adding a certain proportion of what's the yield in the 1 year. So if the Fed have turned the dial up in where the 1 year is going to be, then obviously the yield curve inverts, right? And now nothing to do with the economy is slowing, although, and we must not forget this, and we spoke about it in the last few weeks, there are some signs that the employment in the States is definitely going to come under pressure. And how that influences growth, how much pressure it comes under, we still don't know. But there are signs, and that's the Jeffrey Gundlach chart that we've discussed, shows that there are signs. But nevertheless, what we're seeing on this interest rate sort of disinversion bit was just the fact that the market has figured out that inflation has peaked and the Fed have stopped. They're likely to pause. So this disinversion, which historically would show that when we get a disinversion after we've had a huge inversion, that's when problems really start and you get the recession. But I think in this case, it's just a repricing. It's nothing to do with yet how should we say, a recession. But there is a risk of recession because purely and simply the Fed do not understand the economy. So they're turning the dial left and they're turning the dial right. They don't know what they're doing. And clearly there are some influences in the economy. They just don't know what they're impacting though.
There's an interesting slide I got on LinkedIn. First of all, that is the macro hive slide where actually interest rates should be compared to the former cycles we had in there. I just put that on again for good measure. We spoke about it last week. And I wanted to go to this slide. Yes, Alfonso Picadillo put that out. It's simply a count number of month 2 to 10 year yield curve inversion last before US recession started. And the interesting point is we had a bear steepening in the market. This is now re-inverting. It's getting flatter, getting inverse, more inverted again. And we are at about 16 months before the recession should hit. That's the average. And I looked in February 80 and August 81, and I zoomed a little bit in what we could see here. And again, another sincere question. We always assume that equity markets are forecasting what happens in the real economy. If I look at these charts and look at the inversion we've seen and how many months that was going on, especially in the 80s, to me it looks as if equity markets only seem to be waiting till we have the data. No front running of the real economy anymore. Just give me the data, and when the data tells me we are in a recession, then I'm starting to sell it, but not before. I'm not cleverer than the market again. Could that be a position we are in again, Nick?
Well, it comes back to, are the markets right or are they not right at the end of the day? And we didn't see a bear, well, forget the definitions of what is and what is not a bear market. But in my view, all we saw so far in our in the last 2 years was nothing more than a correction, and it's not the turn in the cycle. The question comes more about interest rates, because that's the one where you could argue that actually the market is forecasting a turn in a trend, whereas equity markets, they manage. We know that the economies over a long period of time grow, and they are going to not stop growing because the governments will continue to throw money to the system. So I think the equity markets have always sussed out. In fact, the 80s less so, but more nowadays, where you say, central banks will always have your back, right? I mean, that's you see that in Europe, you see that in the States. If that's the case, and if governments realize that they can't afford to let the economy go, then the equity markets are, it's going to be really difficult to knock these markets for 6, because there's always going to be somebody there that's going to provide liquidity in the system for the markets to continue to go up. The question really comes is about treasuries. They're the ones that we should worry about for the future. And I'm less stressed about equity markets. Where they go, how fast they go is anyone's guess. But I think, on the whole, at least for the next few years, I see these things going up. And I think markets have kind of picked that up. Why would we be at all-time highs with 5.5% interest rates?
It's only Germany is a bit in the pickle in your logic, right? Because they've just pulled the financial rug from underneath.
They won't let it go. That's my point. And that's what I spoke about last week. I said, why are they in a pickle? Because they need the money. Why do they need the money? Because they need to help the economy along. Yeah. Because the economy is in such a bad state, because they have mismanaged the economy, that it is in such a bad state. But look at it, they're doing their absolute utmost as government, which is what they should be doing. They're doing their absolute utmost to actually get the economy back moving again.
They've declared an emergency again last week, simply for the reason because the Constitutional Court, we mentioned that, took their 60 billion play money away. And you can only indebt the state further against the debt break we have written somewhere in the Constitution, which they're ignoring now, because now we have a special situation again, and I think it's still Ukraine and something else. It's never their own policy which caused the crisis. Anyway, I slipped the slide where I want to have your opinion as well. When we're thinking about interest rates going further down, we have the MOVE index here, which is measuring a broad measure from originally developed from Bank of America of volatility in the bond market. We are at an elevated average level. If I look into the future with my crystal ball and would say, fine, we see interest rates falling. Obviously, there's a correlation, low interest rates, low volatility. Are we going to see that again, or are we in front of the breakout? With all the data we've discussed so far, it gives me the impression that bond volatility is going to fall and follow the VIX as it is at the moment, even if it intuitively doesn't make too much sense for me. That's what the chart here tells me.
Yeah, I mean, my thoughts on 10-year yields, and I turned my view when we reached the target of initially 4.25%, 4.5%, and then yields went a little bit higher up to 5%. I said, you're reasonably fair value at 4.25%, 4.5%. We went higher at that level. It was kind of a no-brainer to put on a trade. And where that trade goes, whether it's below 4%, whether it's down to 3.5%, is really at this stage anyone's guess. But the long-term picture, even if you think that inflation comes down, let's just say somewhere towards their target, but not quite there, somewhere between 2% and 3% inflation. The problem is that the US government will continue to issue paper, and there will come a time where they won't be issuing just T-bills. There will come a time where they will start to again issue longer dated paper. And I think the moment they do, it becomes a lot more difficult to find buyers for this longer dated stuff, just the sheer volume that they have to issue. And for that reason, there is a risk that the buyers of this thing will say, look, actually, we want a higher yield because you're growing your supply of treasury paper between 6 or 7% per annum, and there's no sign of it stopping, and it's going faster. So for that reason, I can't really see yields getting down to where we got to in the past, which means that volatility will probably stay elevated in the move. But where it goes to in the long run, I honestly don't know. I've got no forecast for that, but I'd say it's been worth a trade being long treasuries. You should still be longer treasuries in my view. It could go below 4%, it could go down to 3.5%, but thereafter, question mark, what role it plays in your portfolio, and whether or not yields do sort of trade properly, or whether they're going to be trading purely and simply on the back of the humongous supply that's coming from the US government, from the Treasury.
I'm with you on the 3.5%. Looking back to our conversation about Gundlach's slide deck, it's exactly the point where you would say, okay, I need to refinance myself also longer term. I'm not doing it at these levels, but at 3.5, I will most likely start opening the purse again and say, give me some money. So yeah, I'm with you on this one. So we've got the volatility out of the way, at least on the bond side. Oil, obviously we're both not oil experts, but it's one of these things. The yellow line I've put in here was the invasion from Russia of the Ukraine. And now we are trading at $74 US. The world and its stock, all the guys who are being paid for exclusively forecasting oil prices, we should be trading at 120 if you would have listened to them. That was the trade of the decade, the year, the century. Are we still going to 120, or was it all rubbish, Nick?
Well, we did trade to 120. We traded 120. We traded 130. We went up to was it one?
Yeah, but they didn't say it before.
No, of course not. They never do that. No. They never do that. They're always sort of after the Iran kind of stuff. No, what's been happening? Why has oil come down? It's come down because the U.S. government rightly let go its SPI, Strategic Petroleum Reserves. It added supply to the system. They've actually managed to success. They've done a good job. They've got the price down. China is selling their strategic petroleum reserves. They also don't want to see a higher oil price at a time when their economy, could do with some support. There's increased production, or there's increased capacity to export from the Middle East. So, for now, and barring any kind of external geopolitical event, the supply-demand imbalance is that there has been more supply, and the demand is still growing, but the supply is growing even faster. So for that reason, you're seeing oil prices failing to rally. I'm not necessarily bearish about oil. My view is if we can hold these levels, then it's not a bad place to find a pause. If we break down, let's just say below, if I remember my charts, something like 76.5 on the oil futures chart. What is that one? Is this Brent or oil future? Okay, so 76.5 on Brent. Yeah. Is 76.5 on Brent. If we break below that, then there is a risk down to the 50-60 range. But at 76.5, something like that, I think it's a good place to base. I don't think the oil OPEC want to see prices particularly lower. So this is a fair price for oil to base and then rally again. We'll rally when people don't know it's going to rally.
I think there's a meeting this Sunday, even an OPEC meeting, where they are talking about production cuts.
They just had one, and they came up with, in the end of the day, some production cuts which were voluntary. It's not enough to actually be supportive of oil. What I think they probably want to do is to find a compromise so that they can at least stabilize the oil price. They don't want to see this thing necessarily go down. So the only way they're going to stabilize the oil is if they make non-voluntary cuts, but they make actual cuts in their production rather than voluntary. They make them that they have to do it. But for now, the supply side, there's plenty of oil coming out, and that's
demand.
But it's not to do with the economy. It's not to do with the fact that the world is not growing. This is just a supply thing.
So I was about to say the demand side. If I look at this as an equity trader, so oil, fine. You need oil if you have growing economies. Then there are two ways to skin that bird, to say, yeah, fine. Either we have an oversupply in this stuff, or the demand goes down, or a mixture of both of it. And at the moment, I'm more inclined, looking at this chart, to say, well, I don't see a raging bull market in the economy, and therefore equity markets firing on all cylinders. That might change in the future, but so could we say we have again, is that a stable or an unstable equilibrium we have in front of us, Nic?
For the commodities itself, or what?
The oil. Oil.
Yeah, I mean, it's, at the moment they're trying to get an equilibrium. They're not stable yet because there's just too much stuff coming out left and right, and from this area, from that area. And if you look at gas prices have also been coming down. So, but it won't take very much for some event somewhere here or there for people to get very nervous about gas supplies, especially at winter. And with what's going on in the Middle East, you just don't know when these things would flare up. So, you can't really get too bearish, even if you are bearish.
Yeah. But what will happen, just on a side note, if the war in Ukraine and Russia ends?
Well, where were we in oil before the war in Ukraine? You've got that on your chart.
Pretty much at the level we are today.
Yeah, exactly. And it looks very much as though the war in Russia, Ukraine will come to an end. Nobody can afford that to carry on. The Ukrainians are just running out of human beings. This is just people dying for nothing. There will be an end to this thing in the next 12 months. And in my view, you can put that event as being the story that doesn't really impact the oil price, because there still will be sanctions. There's still, the markets will still behave the way they are behaving with Russia. The thing that I think scares people in oil and gas is what's going on in the Middle East, much more so than what's going on with Russia and Ukraine.
Let's make a hard break and go to most amazing chart, gold. I gave it the headline, triple topping. How many triple tops have you seen on whatever you could think of in the past? There are not many, are there?
No, I mean, but you can see that this level, I mean, if you go back to, what was your high? Is that 2011, I think it was?
Yeah.
2011 was the last time we were sort of there or thereabouts at these levels. And, it's held once, it's held twice, it's held 3 times, and now we're breaking through. And the point is, when you break through a long-term resistance level, and that long-term is for some years, and you break through by, let's just say, more than 5%, and you can hold these levels as you start to go up, you start to create higher highs and higher lows, then the price of the asset, whatever it is, will double. At least. So you can look at, if we were to sort of break this level, then gold is more likely to go to 4,000. And sometimes these things triple. And, that means gold will go to 6,000. So I think we will be in a different environment for gold. And I think that process is already starting. So let's see if we can get above the 5%, above the highs, and then hold these levels as we go up. But gold has always been, from the very first video that we had, gold and Bitcoin and equities have been the thing to own. I mean, it's working.
Yeah, it fits nicely in with what we just discussed about interest rates. Huh? If interest rates see a substantial drop,
that also
dollar coming down, and we are at these crucial levels. I always like to look at a chart like this and say, yeah, fine. Why aren't we trading massively cheaper at interest rates of still 5.5%? No, we are right there at this crucial point where you think, if that happens and we see a breakout, even if you're not a gold bug, it's definitely worth to have some exposure on this trade. Anyway, lovely. So good. I could convince myself that my gold investments are actually quite interesting. We are still in the greedy section of the market, coming back to the original, is it wave 1 or is it wave 1 of 5? Will we see a temporary correction in there? Seasonality's worked fantastically well this year. If we look at seasonality charts for the equity markets, we would see a slight correction now and then buying the crap out of it when we're going towards the end of the year.
Right. Okay. So I think cyclically, the first week of the year, does a lot for whatever asset you're looking for, equities or bonds, and you should just, think that the trend that starts at that stage is probably going to last for a while.
Yeah. So let's go to a slide. The VIX in front of us, we are extremely low levels, 12.62. On the base index on Friday evening at extremely cheap levels. Just your attention to it. Before we had a recession, before we had spikes, we were usually going through this valley of tears at extremely low levels. And
for a
even
while, I mean, it doesn't just sort of go down and then go straight back up. So it kind of bases itself.
It's in terms of chance risk relation. You probably are not making too many mistakes if you are adding up a little bit volatility at these levels, especially if you look at the volatility of the volatility. Like equity options have implied volatility, so has the VIX as an index itself implied volatility, how the options are priced. And every time I see that at levels of around 80, my trigger finger always gets nervous. It's not the volatility I want to sell. And if I don't want to sell anything and my base case thinks that we are mean reverting to historical levels, that's at least a very good point to say, fine, I'm not buying at the top. I'm not buying at the middle of the market. I'm buying at the low of the market. I can still be wrong, but at least I don't look like a right old idiot if I get some exposure into the market yet. And also the good people from Goldman Sachs obviously saw that and published a research for hedge costs. And I thought that was very interesting. What are we seeing here in front of us? There are two hedge strategies. They showed up. One, the dark blue line is a 3-month 98. I say in a minute what that means. 93 put spread annualized. It simply is you have a portfolio which is worth 100. Yeah? You buy a put at 98%, so you're protected for 2%. Yeah? And you sell. You're protected from the level 98 on, and you sell the 93 put against it, which means you have captured 5% if the market goes to the downside. And you pay on an annualized basis roughly 3% for that. What does that mean? First of all, yeah, it sounds cheap. We've seen far higher levels of up to 8% for this hedge strategy. Does it actually make sense? I'm not so convinced about it. You're an investor with real money there. What are you spending your 3% on? You are protected for 5% to the downside, then the market falls by 20%. This is a strategy for a portfolio manager who wants to be better than his mates. Everybody's losing money, but I've lost less money, so hey, I'm the star amongst us. It's not what you as somebody who's managing real money and is competing only against yourself or your pension money would install, even though it is relatively cheap at the moment. The second strategy, the light blue, called a collar, makes far more sense. So what are we having here again? You buy a 95% put, so means you are owning a portfolio, it's worth 100 today. Market falls by 5%, you lose that 5% as well. However, from that point on, you're fully hedged. Yeah? If the market falls 20%, that's it for you. You're good. You've only lost the 5%. How do you finance that? By selling a call to the upside at 110%, which means your portfolio is at 100, the market has another 10% or 15%, your profits are capped at plus 10%. Okay, that's the bad luck. That is the trade-off. You have to pay for it. However, after we've seen a performance this year of 20% or in the NASDAQ even higher, you can say, fine, if the economic scenario looks like Thorsten always tells me it looks, then, and we still see a nice little rally happening in the meantime, I'm in on the upside, but I have a nice protection lying there at 95%. 95%, 5% to the downside doesn't kill me. I only have roughly to make 5% back, but I sleep very well. For a year, you can pick that up for pittance at the moment. This is a good strategy for somebody who actually has real money and is worried about keeping their money. These charts are always, if you're not initiated in options, it's actually, yeah, puts aren't that super cheap because nobody wants to have puts anymore. It's also the relationship with interest rates. Yeah? Interest rates, if the forward, the higher the interest rates, the higher is the forward, which means a call option gets also more expensive because stuff in the future is more expensive. If calls are getting more expensive, puts are getting cheaper and cheaper and cheaper. And that is what we are seeing here on the screen. So the sensible strategy for me as somebody who wants to protect his assets, her assets, in the markets while thinking there is a limited potential for an upside rally, I still want to expose, but I'm happy with 10% if I have it in there. And I don't want to pay too much money for that. Obviously, there are more rinky-dinky ways you can do stuff with it. But I think that, yes, actually a very sensible approach to say, how do I go into the beginning of next year? If I think the party might be over and I need the urge to build up some protection, there you have a trade. And if you, for God's sake, if you want to compete against your fellow guys in the glass towers and you want to be the best loser amongst them, go for the first strategy. You look nicer than the rest of them all. Yeah. So, and the last slide of the day, against a rip of Alfonso Picadillo, who put it on LinkedIn. And this is actually very, very interesting. I think it will be a winning chart he published there. Bonds retain their magic negative correlation to stocks once core inflation sustainably falls below 3%. What I'm going to say with that? We were talking about that for weeks. Is the 60-40 portfolio for the future actually the real asset mix? Your bonds always protected you in the past against a huge decline in equity markets, and that relationship seems to have broken down. What Alfonso did here on this chart, he looked at core inflation, 3-year average core inflation, and said, okay, if core inflation goes below 3% again, then we have this desired negative correlation. The bond part in your portfolio will then assuming that the past will develop like the future against a decline in equity prices. The big, critical point I have here is simply this meaning of core inflation. Yeah. So core inflation is less food and energy, and the super core inflation is less food, energy, and shelter. And we already made jokes about that. What is it then? What does it measure? The price of pencils? Is there any reality in there? But I like this chart because it simply, in a quant way, did show us, yes, fine. If inflation is not a major topic, then we can go back to the old ways. If inflation remains a topic for the future, and I think the path you and I've developed over the last month is this, yes, we see interest rates falling, maybe even massively, but long term we have an inflation problem because states will have to refinance themselves. Then we have at the moment the case to say, fine, bonds are pretty cool to buy at the moment. Simply, we did the bond math as well. If you go long duration, the market, the interest rates fall by 1%, you make roughly 20% profits all in, yeah, with coupons and appreciation of the price. Good protection for your equity portfolio. At the moment, if we go into the assumption that inflation comes further down, core inflation in this case, we can still run around with the old 60-40 portfolio. Any opinion on that, Nic?
Yeah, I mean, I've long been not a fan of the 60-40 portfolio, and that's why I think the introduction of alternative strategies in your portfolio is...
You were absolutely right for the last 3 years, yeah?
So you should be having alternative strategies in your portfolio. The problem is that a lot of funds out there which offer you alternative strategies fail. So they're still run by people whose mind is in the old world, and their strategies just don't work. I mean, our experience on that, it's very difficult to find a good alternative strategy. And the question comes, if you think, as you rightly said, that governments will continue to have to print their way out of all of their problems, so inflation is likely to resurface by virtue of the fact that they will have to sort of increase money supply over time, and that will sort of put a floor on inflation rather than a cap on inflation in the long term. And if that's the case, then you want to be thinking about buying TIPS, Treasury Inflation Protection Securities, because I think they assume a 2.5% inflation rate right now, and or energy stocks and or commodities in your portfolio in order to protect yourself from what governments probably would have to do in the long run. I mean, it's different in China because they've got a deflation. But I mean, if you look at the Western world right now, the Western world has got a debt problem. We know that they want to keep growth alive, and therefore they will continue to print. So in addition to the normal 60-40, you've got to start to think about alternative assets, and you've got to think about sort of inflation protection securities. You've got to think about commodities in your portfolio rather than traditional portfolio construction.
Yeah, I'm with you on that. I switched the slide off. I think it's one of the points I'm thinking all the time about. Yeah, I like that I like volatility as an asset class if employed properly, but especially with long volatility, you have the carry, and the carry is going to eat you away. How do you square the circle in this case when you think, okay, bonds might not the long-term correlation or negative correlation hedge I want to have in my portfolio? I think we have to run the machines a while to come up with some closer. At the moment, I'm feeling comfortable with being exposed a little bit to gold, still having in treasuries investments. I think we said that 6 weeks ago. I think we did a pretty good call on this side. Also, my quants, who were the first to force me into the TLT trade, seemed to work out nicely. And yeah, then we are already through this show. Nic, do you have any fancy last words for viewers?
No fancy words, just Charlie Munger was, he had a few good thoughts in his time, and I think a lot of people have learned from what he had to say. And you should go back and look at what he said. In my view, there's some very sensible things, and it's easy to get caught up in all of this noise that we talk about in the day-to-day but people with a very steady thought process and a strong process about investments, we shouldn't forget that.
Oh, let me close with the last word then, because my famous quote of Charlie Munger was, when somebody comes at you in a presentation with EBITDA, run.
That's great.
Thank you very much for viewing us. If you like us, subscribe, share, and we see you for the last gray market talk of the year 2023 next week. Nic, thank you very much for your time. Thanks for watching us. See you soon. Bye.
Bye.
I was at the hairdresser. Now I have, with this barely any humidity in the air at the moment, complete flat hair.
You're recording this, by the way. So
that's fine. I don't have
to for the audience to know.
Oh, I could put that as a clip actually in front of it again.